Okay, so you've heard Wells Fargo had a solid quarter, but what does that actually mean for your money?
Yeah, that's the thing.
That's what we're here to unpack,
Right.
straight from Wells Fargo's Q3 2024 earnings call transcript.
Yeah, you're right. The raw numbers only tell you part of the story.
Exactly.
What's fascinating here is how Wells Fargo is transforming itself against a backdrop of, economic uncertainty.
Mm-hmm.
We're talking shifting interest rates, a shaky commercial real estate market,
Right.
and a whole lot of competition for your savings.
It's like they're rebuilding the plane while it's still in the air.
It really is.
So let's break it down.
Yeah.
They did post a net income of $5.1 billion, which
Oh,
is
yeah.
up, but I'm curious, where is that growth coming from?
That's the million-dollar question. It's not just the same old loans and mortgages.
Right.
Their strategy has shifted.
Okay.
Fee-based income is a big one, up a dramatic 16% since last year.
Wow.
They're getting creative with things like credit card partnerships and venturing into new areas like, get this, venture capital.
Venture capital? That's not exactly the first thing that comes to mind when I think of Wells Fargo.
Right.
It seems like they're really trying to diversify, but they're also shrinking their workforce, right?
Absolutely. They're streamlining operations and focusing on efficiency,
Okay.
partly driven by that asset cap they've been dealing with.
Right.
Remember that whole saga?
Oh, yeah.
It essentially limits how much they can grow their assets. Things like loans they issue.
So for those of us who need a refresher, what exactly is an asset cap and why should we care?
Yeah, so in the simplest terms, it's a limit imposed by regulators on how much a bank can grow its assets. Things like loans they issue.
Uh-huh.
This was a consequence of some of Wells Fargo's past missteps. Remember those fake accounts?
Right, right.
It's designed to prevent excessive risk-taking, but it also restricts their growth potential until they prove they've cleaned up their act.
So they're operating with one hand tied behind their back, in a way.
In a way, yeah.
But they're still managing to pull off a profit. Speaking of profits, let's talk about those interest rates everyone's obsessed with.
Sure.
How's that whole dance affecting Wells Fargo?
It's a delicate balancing act.
Yeah.
On one hand, higher interest rates mean they can potentially earn more from loans.
Right.
On the other hand, it also means they need to offer higher interest rates on deposits to attract and keep customers,
Yeah.
which cuts into their margins.
It's a tightrope walk for sure, but what I'm hearing is that it's not just about higher profits. It's about strategically choosing where to grow and how to remain profitable in a changing market.
Exactly. And one area they're betting on is those credit card partnerships we talked about earlier.
Okay.
They've teamed up with big names like Expedia and Volkswagen to offer co-branded cards.
So instead of just being the traditional bank, they're becoming more integrated into people's lifestyles through these partnerships. That's pretty savvy.
It's an interesting strategy.
But what about those of us who are more interested in old-fashioned savings accounts? Are those high-yield chasers still draining their resources?
It's interesting. The trend of chasing the highest yield seems to be cooling off a bit.
Okay.
People are realizing that rates probably aren't going to skyrocket forever.
Right.
This is good news for Wells Fargo, as they've been able to lower what they offer on deposits, carefully following the Fed's lead on rate cuts.
Makes sense. You don't want to be the only bank still offering those sky-high rates when everyone else is pulling back. But with all this talk about interest rates and economic uncertainty, there's one big question I know everyone's thinking about. What about commercial real estate?
Ah, yes, the elephant in the room.
Exactly.
The office market is definitely still shaky, with more properties feeling the pinch of lower demand as more people work from home.
Right.
But here's the surprising thing. Wells Fargo seems fairly confident about their position.
So they saw the writing on the wall and started preparing for a potential office space apocalypse. Precisely. They've been battening down the hatches and seem to have a handle on it, at least for now. But it's a slow burn situation, with those losses in their commercial real estate office portfolio declining, but they're still anticipating more bumps down the road.
Cautious optimism, but with eyes wide open.
Yeah.
It seems like Wells Fargo is approaching everything that way these days.
Yeah.
Speaking of which, let's dive into how their different business segments are actually performing, what's working, what's not, and what does it all mean for someone like me who just wants to understand what's going on.
It's all connected, right? Those big picture trends we talked about, interest rates, the economy, they all trickle down to these individual segments.
Okay, so walk me through it. Let's start with the bread and butter, consumer and small business banking. How did they do?
Well, it's a mixed bag.
Right.
Consumer and small business banking revenue actually dipped a bit this quarter, down 5% year over year.
Not great, but why the decline?
It's mainly due to two key factors.
First, those lower deposit balances we talked about earlier, as some customers chase those higher-yielding accounts at other banks.
Ah, so they're still feeling the after effects of that trend, even if it's cooling off. What's the second factor?
Lower net interest income. Remember how we talked about banks having to pay higher interest on deposits?
Right?
Well, that eats into their profits on the lending side, even if loan volumes stay the same.
Makes sense. It's a delicate balancing act for sure, but at least their home lending segment is holding steady, right? Everyone needs a roof over their heads.
You'd think so, wouldn't you? But with interest rates being what they are, fewer people are rushing to buy homes or refinance their mortgages. Revenue in home lending is essentially flat.
Okay.
They did see a small bump in mortgage banking fees, but that's more about them getting leaner and streamlining that part of their operations.
So efficiency is key, which brings us to everyone's favorite topic. Credit cards. Are people swiping less with all this economic uncertainty?
Credit card debt is definitely something to watch, especially as interest rates rise. But for Wells Fargo, it's a bit nuanced.
Okay.
Their credit card revenue actually dipped a bit this quarter as well, down 2% year over year.
What's driving that decline?
They actually saw higher net interest income, meaning they're making more money from the interest charged on those outstanding balances. However, lower fee revenue ate into their profits.
Okay.
It can be a bit of a roller coaster, but those partnerships with Expedia and Volkswagen we talked about earlier,
Right.
those are all about the long game.
So they're playing 3D chess while everyone else is still setting up the board. But those are all consumer-facing businesses.
Right.
What about those bigwig corporate clients? How's commercial banking doing?
That's where things get interesting. Their middle market banking revenue is down slightly, just 1% year over year.
Let me guess, is it those pesky higher deposit costs again?
You got it. It's a common theme across the board, but there's a silver lining. They're seeing some growth in treasury management fees.
Okay, for those of us who don't work in corporate finance, what exactly are treasury management fees?
Essentially, they're fees that businesses pay for services that help them manage their cash flow payments and financial risks. Think of it like a suite of services that help them run their businesses more efficiently, and as companies become more focused on managing their own bottom lines in uncertain times, those services become even more valuable.
So it's like a win-win. Companies get better financial management, and Wells Fargo gets a stable revenue stream. Smart move. Now, what about those really big fish, the corporations that need even more specialized financial services?
That's their corporate and investment banking segment. It's a bit of a tale of two cities. Their banking revenue took a 5% dip compared to last year, again, largely because of those higher deposit costs. And loan balances are down as those big businesses hit the brakes on borrowing.
So not exactly a banner year for lending to big companies, but you said it was a tale of two cities. What's the second part?
Their markets revenue actually increased by 6%. It seems like their investments in rates, structured products, and municipals are paying off. They even managed to offset lower revenue in equities.
Wow, so while one part of the business is down, their expertise in financial markets is helping them weather the storm.
Exactly. They're clearly making strategic decisions about where to focus their energy and resources.
Speaking of strategy, all this talk about high finance makes me wonder how those everyday investors are doing. How is Wells Fargo's wealth and investment management segment performing? So are everyday investors like me feeling the pinch or riding a wave?
They're actually doing quite well. Revenue is up 5% year over year in the wealth and investment management segment.
That's a relief. But what's the driving force there?
Remember those market valuations we talked about earlier?
Yeah.
It turns out when the stock market does well,
Uh-huh.
so does Wells Fargo's wealth and investment management arm of the work. Higher market valuations mean higher asset-based fees, plus they're seeing more activity from people buying and selling stocks and bonds, which also boosts their revenue.
It's a good reminder that even when parts of the economy are struggling, there are always areas of growth. Speaking of which, we've covered a lot of ground here. Is there anything else about Wells Fargo's performance that stands out to you?
You know, when we zoom out and look at the bigger picture, there's a common thread running through all of this.
Okay.
Wells Fargo is a company in transition. They're diversifying, becoming more efficient, and frankly, taking some risks. That venture capital play we talked about earlier,
Right.
that really underscores this shift.
It's not your grandpa's Wells Fargo anymore, that's for sure. But how does this all tie back to the average listener?
That's the key question, isn't it?
Yeah.
Wells Fargo's story is a microcosm of the larger economic forces at play. Interest rate volatility, a shifting landscape in commercial real estate.
Right.
These are all things that have the potential to impact your financial life.
So what's the takeaway for listeners? What should they be watching for in the coming months?
Pay attention to how Wells Fargo, continues to evolve. How are they adapting to those interest rate changes? What moves are they making in the credit card space? Are they doubling down on those successful ventures? Their journey is far from over, and it's bound to be full of twists, turns, and valuable lessons for all of us.
It's like they're navigating uncharted waters, but they're doing it with their eyes wide open. And for listeners, understanding those same waters is key to navigating your own financial journey. So keep learning, stay curious, and until next time, happy investing.